Well, let's welcome in Amish Shah, Head of India Research at Bank of America Securities. Amish, good morning. Great to have you back on the program. It's been a while. Thank you very much, and a lot has happened. We can say a lot has happened, and it's kind of two steps forward, one step back. Just a tremendous amount of news flow to deal with. But Amish, where are you at in terms of your thinking about what the market is likely to do from here? There is general slight amount of desperation which has crept in about earnings being a little slow. Although when you take stock, earnings performance delivery so far has been better than what the general perception has been. The hard numbers show that. What is your sense, Amish? How do the markets do from here over the next couple of months?
Thank you and good morning, Prashant. I think the incremental news these days is obviously around trade tariffs. But even if you set that aside for a moment, I would continue to argue that the fair value for Nifty is 25,000 by the end of this year. We have stuck to that target for about 14-15 months now. I continue to believe in it. That basically means only about 2% upside from where we are, about 6% upside for a year as a whole. So if you're a long-term investor with a buy and hold strategy, I think this is not a great market for you. If you're a nimble investor, able to play the market volatility, if you can rotate sectors, I think then there is alpha to be made. So that's as far as Nifty is concerned, minus the trade talks. The moment you bring the trade talks, obviously that adds to some amount of risk, and therefore whether the tariffs will settle down at 15 to 20 or 25 or 50, the sensitivities vary. So if it indeed stays at 25 to 50%, I think there is a decent amount of downside to the market because markets have not priced that risk in. And that's our base case as well. We don't think that we can continue with a 50% tariff eventually. And as far as the mid caps and small caps are concerned, we continue to believe that they are very rich. They have underperformed this year. They will continue to underperform the Nifty through the year is our thinking as of now. On earnings, Prashant, you are right that they were slightly better, but it is just at the margin. So if you look at the ratio, 52% companies have delivered a beat, 48 have shown a miss. But the quantum of the earnings itself is not that very high. So we had 5.5% earnings growth in F25. On the top of that, we think there will be only 7% Nifty earnings growth this year. So to sum up, I think in between the earnings season, markets may have a rally on the hopes of an earnings recovery. But during the earnings season, I think markets will continue to correct as earnings continue to disappoint.
Okay. All right. Hi, Amish. Good to see you in. You're sounding a little bit cautious then in terms of the near-term view on the markets. But one sector I think you've gone ahead and you've upgraded is IT. Looking at a couple of data points out there, and if you compare IT valuations in comparison to the Nifty, that's only at a premium of close to around, I think, 14-15%. We've normally seen it bottom out here. And if you compare IT valuations with the NASDAQ, actually, it's at a discount of close to around 20%. Normally, we have seen it based out at around 25 to around 30%. Tell us what is the rationale with regard to IT? Because growth is going to be very feeble, but now you have the dividend yield, you'll have the cash flow yield as well that could support the stocks. Tell us more.
Absolutely, Nigel. So you're spot on. All the reasons that you mentioned are actually valid on the back of which we are looking to upgrade it. And it comes back to the point I was making that if you are nimble as an investor and if you're able to rotate sectors, then there could be some alpha generation possibility. So IT, I guess everybody knows that the business outlook is subdued. It's priced it into the stocks. Incrementally, at least the negative news flow from here is unlikely. This, from a positioning perspective, heavily shorted sector. And in case if there is even if the companies just meet their guidance, they don't even have to beat it. I think there's a possibility of a short squeeze. So it's a tactical buy for a large cap sector that we are looking at.
Hi, Amish. Great to have you in. Yeah, sobering thought, right? It's been a tough year. I was just contrasting numbers a while back. Indian market 1% at the index level, whereas the US market is giving you 20% on the S&P 500, 27, 28% just on the NASDAQ. I mean, even if you're just an ETF investor, right? Forget picking any stocks. So since you're saying that sector rotation will be the key to making money in this market over the next couple of months, so IT is one. What else should you keep on your radar to be nimble when that opportunity arises? Because it's moving very fast. Look at these durable companies. They made great wealth and suddenly one knock and all of them got whacked out. So apart from IT, which other sector do you think can rotate on the upside quickly?
So, Subhi, two sectors that we have changed literally as of today. So utilities, and more particularly the power utilities. We were underweight on these names all this while. We now think that they're at least fairly priced. You may not be able to generate a lot of positive returns, but they're dividend-paying stocks, can be good defensive in a current volatile market. So utilities goes from underweight to neutral weight. And certain consumer discretionary segments. So we were generally bearish on consumer discretionary and consumption pack overall. But we've now, after the correction, we have now started liking consumer durables, building materials, some auto components, and then travel and tourism. So some pockets of consumer discretionary is what we've upgraded as well.
Interesting. So that's a call on consumer discretionary. You said auto components or also auto? Because large auto is seeing some accumulation. Even the forgotten, beaten down stocks like Maruti, etc. I mean, we're seeing some consistent buying come back over there.
So the auto components is the change that we have done. Within the large cap autos, we continue to like passenger vehicles and commercial vehicles. We are bearish on the two-wheelers, but that's not a change in call. We have that call for a while now.
Okay, Amish, just a quick word. I was putting this data out. Another reason for India's underperformance, and this is just kind of sort of, I'm wondering whether this is true, is the lack of AI exposure that investors can take here in India, foreign investors especially. Has that come up as a point of conversation, apart from everything else? Go on.
Well, Prashant, that's a very valid point, and the arguments on both sides. Even for the IT sector, the debate is obviously out there in terms of whether it will benefit these companies in the near term, like a cloud revolution had benefited these companies, or will it disrupt these companies? So there's a debate out there. We are still in the camp that at least as far as the next 2-3 years go, AI will first be an addition to the business for these companies and eventually perhaps a drag over time.
Okay. All right, Amish, good talking to you this morning. New ideas and perhaps a new approach to deal with the market that's been testing investors' patience as well. Thanks for joining in, and we look forward to more conversations through the course of the year.